Recently, there was an article in one of the leading newspapers which claimed that one of the tax residents of Singapore, she's an NRI, she didn't have to pay any tax on the capital gains of over 1.35 crores on her mutual funds. This news spread like wildfire, and a lot of inquiries have been coming from NRIs. So I thought I'll make a video around NRI taxation, and maybe if you have any questions, I would make one more additional video on this series. So India has actually signed DTAA, which is Dual Tax Avoidance Agreement with over 88 countries, so that if you pay taxes in India, you could actually get credit in the country that you're a part of or that you're residing in. If you're in a country which taxes capital gain at 20%, and India, if you've already paid, let's say, 1.5% of taxes, in your residing country, you only have to pay 7.5%. You need to consult your tax advisor for complete details on this. But the interesting twist is that many countries that I know of, like UAE, like Singapore, like Switzerland, like Portugal, like Spain, do not have capital gains for their investments, which means that you pay taxes only in India. So there is a way in which you could avoid this, and this is absolutely nothing new. This is applicable only for mutual funds. There was the way you could avoid paying the TDS, the tax deduction at source that all the mutual funds charge you on the capital gain, is by proving that you are a part of these countries by submitting certain set of documents. I would share with you the details of the documents that are required for you to avail this benefit. Plus, I'll also tell you in brief the process and my interaction with AMCs and how it actually went. So there are about 5-6 documents. First, you need to submit something called tax residence certificate, which will be issued by the country of your current residence. You have to submit Form 10F, which you can actually download from the income tax website. That has to be submitted. You also have to submit DTAA Declaration, which is to show that you're part of an ex country which has a DTA agreement with India. You have to, of course, submit your passport and PAN card. You have to submit a covering letter for each of the folios that you have with each of the AMCs. Plus, you also have to submit a proof of overseas address. Is obtaining a TRC from your country of residence easy? Absolutely not. I've tried it for about 2-3 clients, especially in the UAE. It was very challenging for us to get the TRC certificate, and the process was largely time consuming. The DTA needs to be reviewed, and every financial year you need to submit it. And the bigger issue is you have to submit each of these forms to each of these AMCs. Plus the Form 10F, I mean, which was not a big problem. You could actually download it from the income tax portal. It was not as easy as it sounds. So a lot of my investors gave up and they said, let me pay off the taxes. And then they used to claim it back. And that's what most of the people did. But there's also another way in which you can absolutely avoid, provided you have larger sum of money investing or want to invest more money into India. You could go the gift city route, in which you do not have to produce none of these documents. You in fact don't have to do Indian KYC also. You could invest into India, into Indian mutual funds via mutual funds that are registered in gift city. More on that later. But let me clarify, this is nothing new. The tax avoidance agreement has always been there between Singapore and UAE and many other countries. If you have the time to do it, and if you see that the time is worth taking an effort for, you should go ahead with this. If you have any questions, please let me know. I'll answer them. Happy investing.